Welcome to this session, which is Fundability and Valuations, an Investor's Perspective. I think during the course of this day, lots of questions have been raised around this, and you have a very eminent panel, all the way from an accelerator to a growth fund. Is this better?
Yeah.
Thanks. They'll give a take on their perspectives. I take the opportunity to invite our first panelist, Padmaja Ruparel. Padmaja is the co-founder of Indian Angel Network. They have an experience. Padmaja, please. The network itself has an experience of investing in about 100 odd companies now. And Padmaja, why don't you take the first seat? I know you have a early exit out. Our next speaker is Vikram Updhyaya. Vikram is with GVC Accelerator. He founded the Accelerator. They have 11 companies right now in the portfolio. They give about $100,000 to get you started once you come in. They come in after the proof of concept. So welcome, Vikram. Both Padmaja and Vikram would be constrained for time, so we'll do a hard stop on them at about 5:20, and hopefully they'll be on time. Our next speaker is Humayun Mazhar, Cres Ventures. He's also the president of TiECON. Thank you for coming over. He himself has an interesting background. Did technology ventures. They have an angel fund. They've invested in 2 companies in Pakistan and looking to invest in another 2. Our next speaker is Shanti Mohan. Shanti Mohan, we've had her before. She's the founder of Let's Venture, India's largest marketplace for connecting investors with entrepreneurs. Welcome, Shanti. Our next speaker is Abhi Dhall. Abhi Dhall is with Multiples Private Equity. He's been with them since the inception. He's been in the world of technology, a Harvard Business School grad, and he leads the technology investment practice at Multiples, and Multiples has about $1 billion corpus. They make growth stage investments. Thank you, panelists, for being on board. Just to get the ball rolling, I thought I'll be the first one to ask a set of questions to all one of them. And given these constraints we'd have and a number of questions that are going to come up, I'll give each one of the panelists some time, but just limit your response. The first question is, what do each one of you look at when you are looking at making a decision on an entrepreneur? Padmaja, you first.
Thank you, Puneet. I think before I just respond to you, Puneet, I want to acknowledge that it is only in platforms like TiE that we have India and Pakistan sitting on the same
Yes.
platform. So congratulations, it's a coup. So, all of you have been in the sessions through the day, so some of it may be repetitive. But when we look at from an early stage startup where there's really no major product in place, or the data is all projected largely, there's nothing that is concrete at the stage that we invest, there are a few things that we look for. Number one is a proposition, which could be a product or a service, which is unique. And what I mean by unique is, does that do something different or differently? Does it cater to a market which is high growth and large, and therefore it is implicitly has to be a need to have rather than a nice to have? Third, I think is an ability of the team, which I mentioned earlier, is to me the entrepreneur and the team has to be really kick-ass to be able to take it to the next level and build a team which can grow and scale and do whatever is required. Fourth, can they deliver? If it's a product, can they manufacture or develop it? Or if it's a service, can they keep providing that service, whatever? Is it deliverable or the execution of it possible? Have they understood competition and the space? And the last two is really, can they collect the monies? Because at the end of the day, that's what hits the bank accounts. And have they understood the risk and the risk mitigation strategies? I think to us, those are the 5 or 6 points that we look at.
And what's the range of investments the group makes?
So we invest from 25 lakhs to 6 crores, and we've also done a 10 crore deal. So we are quite open to looking at deals right up to double digits.
Okay. Thank you. Vikram?
Thank you, Puneet, for this opportunity to explain the investment thesis. Before I come on the point of how we look at it, let me mention that I've been hearing some of the sessions about comparison of Bangalore with Chandigarh ecosystem. Well, Chandigarh is doing really good, and some of the portfolios are rocking from Chandigarh. The first portfolio we picked up in GHV Accelerator is from Chandigarh, and we picked up at the stage of idea, and they got next round of funding 60 days after us, and they are growing with leaps and bounds, and the numbers are amazing. They are in the hyperlocal space, and the startup name is called Lazy Lad. So Chandigarh is rocking not only in India, they have investors from Singapore, Japan, and US. Now, coming to the point of the investment thesis, since we are an accelerator, we come at a very early seed stage. So we have our own investment thesis, which is non-GMV. It is very simple formula called test POC. Now, this test POC stands for the team, as we have been talking about again and again. What we look at it, the team is the relevance of their expertise with respect to the venture, followed by the execution capability, that's the E of the test, and whether they can scale up or do a scalable business model using technology, the last T in the test. And definitely, since we are putting a capital, we want to see the skin in the game. We generally decide on the proof of concept they are able to execute. So that's our always a take, and so far we have invested in 11 startups.
All right, thank you. Humayun?
I think the first thing we as Cres Ventures look at is the idea. Most of our due diligence is very easily done because the parallel we compare it to is India. So if we see that happening in India, sooner or later it comes to Pakistan, same culture, same set of people. If it happens to be from Punjab, more applicable to where I am. The second thing after we look at obviously is the entrepreneur or the founder. The main thing we are looking for a founder entrepreneur is whether we can work with them. That's the key. We work very closely with the companies we invest in and with the founders, and we have to make sure from day one that they are someone we can work with in the long term. As far as the founder entrepreneur is concerned, the other thing we look at is his risk aversion level. Another angle we look at is the emotional intelligence part of it. We've come across some very fantastic ideas in Pakistan. We started in October, we've invested in 2 companies so far. And as it happens, when I was coming to Chandigarh, the guy who picked me up from the airport was running a tech startup. And it's the first company in Pakistan which I've invested in is the same. And Jugnu, which you heard earlier, actually before I flew out, I closed my second investment with a company which is doing the same thing in Pakistan. So a lot of parallels. For us, our homework is done. We're looking at the Indian market, we're looking at what's happening here. So a lot of due diligence for us is already done. So we spend most of our time on the entrepreneur or the founder and getting to know him and see whether we can work with him.
All right, thank you.
So we are an online marketplace. We've done about 62 deals in the last 2 years. And what we look for in the entrepreneur is, I would add to what Padmaja already mentioned. So all the 6 points about product, traction. But at the end of it, 2 primary questions. One is, are you solving a real problem? So is the problem real, or is it like because everybody is raising funding in a particular space, you're coming up with another niche vertical in that space, right? So have you understood your customer? Are you solving a real problem? And for me personally, when I look at entrepreneurs, I ask one question is, do you have a backup plan on your venture? And if your venture should be your only plan A you're working on, there cannot be a plan B, and you have to have complete skin in the game when you're trying to build a venture.
Thank you. Abhi?
So I think the reason why I am sitting on the 5th spot here, because we come in the end of this financing round.
All these deals end up with you.
So a deal or a company or an investment would generally come to us typically when it has gone past, let's say, Series B. Our ticket sizes that we would deploy into companies range from 20 million to about 100 million. It can be north of that as well, but generally I would say that will be the median range we'll be investing in. So these are pretty large ticket sizes. So clearly by now the company has progressed significantly. It has made some traction, it has real clients, it has shown some unit economics. But end of the day, what we look for is fairly similar to what everybody on the panel sort of articulated. And so one of the most important things to us is actually the promoter or the founder's DNA. What I mean by that is, what is the real reason why this person got into entrepreneurship, right? We try to get multiple layers deep into understanding that one aspect. So there's a lot of behavioral things we look into to understand why you started the business, what is the passion that you bring to the table, because single most biggest determinant of success in ventures ends up being the passion that the founder brings to the table. Because there are times when companies don't do well because the opportunity has not met the effort of the promoter. There are macro cycles that come your way. But if the founder is passionate about it, then and the founder has the eye on the opportunity, the investment and the company, both for the founder and for us, will make money in the end. So that is the single biggest determinant. The second thing we look for is obviously a large market size, but beyond that we carefully look into the market structure. So what do I mean by that? I'll just take a quick example of a company I invested in called Delivery, which is an e-commerce logistics company, right? And we carefully looked at the fact that there are fragmented set of buyers. E-commerce is there to stay in the country and so on. So that's all the the usual good stuff. But what was interesting here is that you had a player like Blue Dart, which was a top-notch player in this industry, in the e-commerce logistics industry, which was pricing the product 25% higher than Delivery. So you knew that if this company did well, you knew that there is going to be ability to actually price up, right? So it's a very interesting structure of market where this play is actually operating. So that's another big factor we look at. Third thing we would look at is differentiation, and is the idea differentiated enough? So for example, in this example of Delivery, one factor that differentiated the company was their technology backend. That tech backend actually allows a fragmented set of several delivery boys to actually work in a very systematic manner to take packages in a very predictable fashion from point A to point B. So technology enables people to work predictability, which then brings predictability in the results, which are then evident in the metrics that the client shared back with us when we spoke to the likes of all the large e-commerce companies, right? There was a massive delight that we found in the minds of the customer, and that was the reason why the delight was there. So that was a differentiation that was there inherent in that business. These would be the three important things. Fourth is obviously unit economics, and by the time the investment gets to someone like us, we really piece it apart. Trust me, we really get down to the details of how, because by the time everybody here has funded them, a lot of business has, a lot of water has run under the bridge. So by now a lot of data has been generated, and we really piece apart the company to figure out how exactly is the company really working, what is the unit economics. So for example, in the case of Delivery, we literally broke down the company into 3 parts and said, there are 3 parts in this company. One is your last mile delivery network, which is your branch to the delivery of your e-commerce package to your home. The second is when a package goes from, let's say, a Delhi to a Mumbai on an airline or on surface transport. That's called the line haul. And then the third part is what I call the collection network, which is where you pick up in a milk run fashion packages from various sellers, bring them onto processing centers and hubs. So what does it cost to do that business individually in each of these 3 parts? And where is it trending towards? Because you break this company down, you find that there are two parts in this company. There's a very mature part of the company, and there's a very emerging part of the company. In the mature part of the company, you find that the unit economics is actually becoming highly, highly profitable. And that's, that then becomes a very strong thesis for us to actually walk in aggressively into an investment. And the last thing I would say that we look for is, again, that's selfishly from an investor standpoint, is the exitability of the investment. That is a criteria that we always keep in mind, because ultimately we get the money, this $1 billion that we have gotten from large global pension funds, large endowments, is because they are looking for a return for those pensioners whose money has been invested by people like us. So therefore, there's a fiduciary responsibility on us to make sure that that money earns a hefty return at the end of it as well. And that's basically what in a nutshell, what we look for.
Thanks a lot, Abhi. My next question to the panelists, for each one of them, is around this whole black box of valuations. We tried to attempt and take a peek at it. There are many ways to do valuations. Some speakers have said it's ultimately in the eye of the beholder. There are some thumb rules around valuation. Every round you invest in, you will dilute between 10% to 40% plus minus. There's some theory that investors want to have sufficient, but yet leave enough for the entrepreneur and the team that they make money. So what is it? I mean, if you look at the numbers, you'll probably see first round, first small, whatever, family friends round, raised a couple of lakhs, 30, 40, 50 lakhs, lost 20% of the company. You see another thing, you raise $400+ million, you dilute 40% of the company. What is it? How do you guys do the valuations? I'm going to ask each one of these investors on what their thumb rule is, give or take some. On an angel round, what are we looking to dilute?
So that's a deadly question, actually.
I know, that's why I asked this. And this was a googly because this was not discussed between us, so.
That's correct. So at the level that we come in as angel investors, purely from that perspective, because Abhi's calculations will be completely different basis when they come in perhaps. So I think some of the things that we look at is we don't look at DCF. We don't look at any formulas when we do valuation, to be honest. There are 3 or 4 ways that we look at valuation. One is, do we like the company and do we think how much value add beyond money that the investors need to put in? That is one big question, because there is a value or there is a valuation to the value add that the investors do beyond money, number one. Number 2, when you're angel investing, it's absolutely clear to both the investor and the promoter that there will be some heavy lifting that the investors will do. And therefore, for the company to take advantage of that, and here I talk about angel investors who are doing more than just passive investing, they're actually helping the company grow in different ways, that there needs to be enough of an equity with them that you can grab their mind space. If they have just 5% of your equity at this stage, they really don't care. They're just not going to put in the time, they're not going to put in the mind space, they're not going to put in the effort. It has to be a little enough for them to be able to say, yes, this is my company, let me think about it, let me do A, B, C, D. The third is the fact that if there is an investor who's taking a majority, he's not an investor, he's an owner. Because then the entrepreneur becomes a chief executive officer. So he's become suddenly from a job creator to a job seeker. But on the other hand, if he's got too little, as I mentioned earlier, that doesn't work either. The real crux comes, therefore, is how much do we take? And in angel deals, if you look at it, typically we've seen it ranges between 15-17% to about 25-26%. Largely, that's the range, plus minus something. Now, between that range, you play the game. There is a bit of negotiation, I don't deny that. But I think what does happen is there is no number-driven, formula-driven that should it be 22% or should it be 18%. I think what you need to look at it, what is it that is the optimum for you, which you as an entrepreneur are happy to give, and what is it that the investor is happy to take. And if there is a meet of minds, and as Shanti said, or somebody said, the chemistry is important, I think that convergence comes through. But ultimately, the valuation really has to result in one thing for the investor. He has to be able to exit. He has to be able to get the next round investment. And if an exit in a next round investment is from another VC, he has to make sure that the entrepreneur has enough so that the next round investor finds it interesting to come, on the one hand. On the other hand, he has enough so that he can help the company scale and get ready for the next round investment. So I think these are the different factors that play a role, and we've seen all or some of them play in every negotiation that we go through.
Thank you. Vikram?
Well, I have two thoughts, as I carry two hats. As an angel, I echo what Padmaja has mentioned because I represent the same angel network. But when it comes about GHP Accelerator, as an accelerator, we have to accelerate the startups. The first thing which we realize is like startups waste time in negotiating, discussing, and raising money. And since we come at a very early stage where the proof of concept is just achieved with the repeat orders, just to build a projection that it will grow in future. So what we have done is we have made a fixed formula, $100,000, 20%.
All right.
And that makes entrepreneur's life easy. If he's a great entrepreneur as a team, that's the first T in the test POC, with a strong execution capability, highly scalable model he's working on, using technology, and the proof of concept is in place, you are most welcome, the doors are open, and we put 20% against 100K, and we accelerate for 12 months max. Also, we help them to go to the next round of investments, pre-Series A, Series A. So far, we have invested in 11, and it took us not more than 2 weeks to close with those who fit in this test POC. And we have 11, 2 of them close pre-Series A, they have the Series A term sheet signed, and all of them are having a great hockey stick growth, not in terms of the GMV, in terms of the operational, out of 11, 3 have, they have achieved the operational break-even. And they are cash flow driven growth business models, and that's really helping them to grow fast. So it's very straightforward from our side.
Right. What's been your experiences?
Pakistan, slightly different perspective. Tech startup scene is happening right now. A lot of angels jumping in. Everyone and their uncle wants to be an angel. Too much money chasing too few companies. So we're competing in a marketplace. So what do we look for? We look for companies which are looking for smart money. So I believe in this principle that you can't pay less for a good product or service. So that's one of our guiding principles. So if it looks like a cougar, acts like a cougar, we're going to pay a premium over the market to get that in. The other thing we're looking in the companies, we don't take, in any company, we don't take more than 30% stake. That's the maximum we'll take. Because we understand they're going to raise further rounds of funding, and you don't want the owner to be diluted. The only clause where we are a bit strong, because you're young, or you're working on very young entrepreneurs, is vesting. So that is very, very part of our investment thesis. But it's very basic, not much evaluation. We look at the Indian model, but if it's not there, and if we like the idea, it's just negotiation, basically.
So Humayun, in your last 2 companies that you guys have funded in Pakistan, how much for how much?
Average ticket was about 150 to 200K. And in one company, for the same amount, we got 15%, another company got 30%.
All right. Thank you. Shanti, what have you seen now? 62 companies you guys have had experience with that have gone through your network.
Yes.
What are you seeing? How much for how much?
Yeah, so we have actually somewhere, I think, probably changed the valuation numbers for startups because of the fact that we are more a global platform. So sometimes what happens is when an investor looks at a startup in a market which the startup is working on, like a global investor, he actually understands the value faster and he's willing to pay a premium because he's willing to invest in it, right? So I think we have actually seen a couple of startups who've come and we've told them, no, you should be changing your valuation numbers to the benefit of the entrepreneur. Right? But at the end of the day, I have kind of two thumb rules which I kind of use when we look at valuation. One is that valuation is, if anybody tells you there's a formula, they're not telling you the truth. Right? So there is no formula to valuation. It's how much somebody is willing to pay for your business. How desperate is the entrepreneur? How desperate is the investor to get into the deal? That is one. Second is, what is not good for the investor or what is not good for the entrepreneur is not good for the investor. Right? So you can't take away 40 or 50% of a company in an early stage round and then actually expect to get an exit because you've already taken too much from the company. Right? That is the second point. And third is just a very basic kind of business basic is that valuation follows equity distribution, right? So you need to have enough in the company for the company to be able to raise a series A, B, C, so that they are able to scale, and the founders still should have enough equity left in the company to be motivated to continue to build the company. So we are actually seeing valuations from anything from probably 12% to about 25 to 30%. So it depends. It is a very, very broad number, right? And there are a lot of parameters which again...
I know, we're just talking at a very, very high level.
Yes, yes.
But within what you are seeing, some sectors more valued over others? If you were to again just go down, what are the sectors you're seeing that are highly valued on your network and some that are...
So actually the kind of distribution we've seen on our platform is we've seen, if you look at healthcare, education, e-commerce, mobile apps, right? So basically tech-enabled startup. And I think the reason is because tech gives you scale and angel investors get an exit when the company scales. Right? So that is the kind of connecting formula, right? So I don't think it's about a particular, and it's also about the market you're trying to address. So since apps and consumer is actually a larger market to address, right? So those are patterns, yeah.
I just want to add to what Shanti said. I think there is a change happened in the last 6, 8, 9 months, 2 or 3 quarters. I think valuations have moved from being user-based and eyeballs and likes. It has, and GMV, it has actually got to top line and bottom line of the company. So people are, investors are evaluating companies more on the business itself, on the top line, bottom line, which is great, I think. And the second thing which we keep hearing on the network, at least, and I think it's in the ecosystem, that have the valuation started dropping. To my mind, I would tell all entrepreneurs, it is only 1 or 2 sectors where there was fluff and that is sort of settling down and becoming a little more real. But if I look at a large part of the other sectors, be it healthcare, education, IoT, agri-tech, all of those, I don't think there's been a dramatic change in valuation. There wasn't really at the outset a big bubble for it to settle. So entrepreneurs who are coming in, it's not that suddenly the market has dropped off the cliff.
Thank you. Abhi?
Yeah, so I agree with Padmaja that investors are now increasingly looking for profitability as a metric to value companies, and I think that was evident when the recent market fall happened in the US, where in the listed space you saw LinkedIn falling 50%. A lot of it was driven by those things, but a lot of it was also obviously driven by the fact that there is a fear of a global slowdown. China is slowing down, so hedge funds which have traditionally not invested in these private markets are basically now tied on both public and private markets, and they decided to kind of get more conservative and move their capital allocations towards less risky sectors. So this is where the rubber meets the road. Profitability is key at the end of the day. But if you ask me about valuation, Shanti is absolutely right. Valuation is both, I think, an art and a science. There are both aspects to it. There is a part of it, some factors that go into valuation end up being, great companies end up valued very highly, right? That just goes without saying. You look for good companies, you will have to pay value for those companies as an investor. So that is one thing at least late stage investors recognize. That said, by the time a company comes into a later series round, because the unit economics has been determined to some extent, obviously not to a full extent, at least we go into the science part of it, goes into figuring out what it could look like in 5 years from now, right? And then taking your gut call on Therefore, if you look at multiples in this industry, what do companies trade at? And if there are no comparables available, you look at surrogates in this industry and for other industry and say, okay, similar business models, highly cash generative businesses, what do they trade at? Highly volatile cash flows, what do they trade at? And you basically then come up with some, 3-4 dimensions or directions from which you arrive at evaluation. Nothing gives you a precise answer. At the end of the day, it's, as you said, it's an art. And to some extent, it's determined by the competition in a investment or a deal situation that you're in that also drives the valuation eventually. So that's, you look at multiple factors to arrive at that one number at the end of the day.
Abhi, I will ask you, you guys have invested, given some large checks across diverse sectors.
Yeah.
How much for how much, if you were to look at it average?
Sorry, so how much for how much?
How much money, how large a check, for how much, in terms of equity?
I cannot answer that, unfortunately, because if you look at our portfolio, it's a very, very diverse portfolio.
It's a very diverse portfolio,
We have a hospital that we own. We completely own 100% of that hospital. It's a buyout transaction. There are a bunch of listed transactions. We own a significant stake in PVR cinemas. We own a big stake in, a small stake in Arvind, which is a listed company. We own almost close to majority stake in a company which is in the agri space as well. So it is so much different and across the board that it will be hard for me to answer that question.
Fair enough.
It just changes by sectors and the type of company, listed, unlisted, controlled transaction or a minority transaction for us.
Understood. Questions from the audience? This gentleman right there. I'll come back to you. Right there.
Hello, good evening. My question is, when you invest in a company, how you look about the promoter's ethics, apart from the valuation, passion, like in this side of the setup, if you more or less, there's a like scarcity of the fair promoters, like the issues of under invoicing, over invoicing when you invested. So how you address this issue, how you filter those kind of promoters before investing those companies?
The question he's asked is, how do you evaluate the ethics of an entrepreneur, especially around money siphoning or over invoicing, under invoicing?
It's a very good question, actually. So ethics and execution are the two key things that I think any investor looks for. Again, from an angel perspective, I think we do a lot of reference checks. We pick up the phone, talk to peers, we talk to your previous bosses, we talk to associates, whatever. We do whatever reference checks we need to do. We also speak to people, your friends, associates. Before we invest, we do a full financial and legal diligence in your company. And that throws up the questions that, the answers to the questions that you've raised, whether there's any siphoning off, whether there are transactions which are suspect, or any of those. We also go through, if you have an IP or you claim to have an IP, then we do the IP checks. So there are 3 levels of diligence that happens before we invest. So one is background check, strategic, all your reference checks. Then we do a legal diligence, and then we do a financial audit kind of a diligence. Does that answer your question?
Anyone else wants to add anything? Shanti?
Yeah, I just had one point. So actually we had one of the investors, we asked him, if all things being the same, what is the one thing which if it is not there, you would not invest, right? And he said ethics. So it is like the basis of investing, right? Because if the ethical part of the business and the founders is not in place, I think it's not an investable business at all.
Just to add on, over and above what Padmaja and Shanti just mentioned, is we look for the skin in the game from the entrepreneur. If the entrepreneur is putting their skin in the game, I think the ethics, definitely we check it from the reference, the duty and all those things. But if the skin in the game is quite high, the risk is high, I think the ethics comes very close to the expectation what we look for.
But I think also there's an underlying question. I'm going to come to Abhi right on this one. Because
Just to add to it.
Sorry.
How many people have watched soccer? Football, soccer? Very few, surprising. ethics are there, I mean, but then you're looking for an entrepreneur who can tweak or find the loopholes. So if your entrepreneur is very ethical, very simple, very nice guy, good to have, good to know, he's not going to run away with your money. But then he's missing a key link. Chief executive, you're looking for a company, is someone who's going to find these loopholes and tweak. That's one ability we at least look at. Given the nature of business, given the nature of our countries, that is something they have to be able to be good at. So there's a very thin line between pure ethical, clean, Mr. Clean guy, or someone who can do it. And just to give you an example of soccer, it's highly regulated. You've got the third referee, you've got the goal line technology. Even then, the hand of God by Madonna or something like that happens. So that is something we
And now I'm going to ask the same question to Abhi, because at early stages, a lot of these questions may not show up because you're pre-revenue, your proof of concept. Lately, a lot of these issues are beginning to show up in private equity investments in later stages where there has been conflicts between the promoter and the private equity company. So Abhi, your thoughts on that?
Yeah, I would say, I would echo the point made earlier that ethics is the underlying, the basic minimum, and actually one of the most important things, that we look for, because that ultimately determines whether there will be an exit for us in the company or not. Whether, so clearly we're talking about an instance here, let's say the promoter or the founder is not ethical. The promoter might make money in that situation at the end of at the end of the cycle, but the investor may not, right? So that is the reason why it gets very critical and important evaluation for any fund in general, and much more so for a later stage fund. Lot of that happens, through your conduct, actually, right? How you conduct yourself across various meetings. When anybody meets you, any of us will meet you, I'm sure we'll talk about not just about your business, but about 100 other things, that interest you, what you do in your life, how you've gone and acted in various instances, your references, and that have been pointed out. All of those are indicators, and obviously there is no perfect science to determining that at the end of the day. Because if someone is there to cheat and intends to cheat, they might as well cheat, and you just probably never know. But you can only minimize the probability that will happen by doing all these, bringing all the checks and balances into the mix.
Thank
so
you, Abhi.
There have been such cases lately.
Yeah, there have been quite a few of them. Yeah.
Hi, I'm Saurabh, and my question is for early and seed investments. Is it really necessary to evaluate those early stage startups? And what's your take on convertible debt? Isn't it fair for both startups and the investors?
So I'm going to be a little provocative. According to me, convertible debt is a very lazy instrument. What an investor is doing and what an entrepreneur is doing is basically postponing the decision of valuation, right? Because you're just saying that someone else will decide the valuation at some point, and I will take a discount of X percentage, 20, 25, 30, whatever that percentage is. But what it does for an investor, just so that you have a view from the other side, is the investor is not only postponing the valuation decision, but he's also capping his returns. You see, so he's just saying that I'm investing at a certain amount, and let's say within 12 months you go and raise money, I will be at 66% or 67% of that round. Whereas he could well be he could have gained 100%. So in an early stage, seed stage kind of a scenario where investors are investing, it is the highest risk asset class for the investor. So he has to maximize his gains and minimize his risk. So why would he want to cap his returns by putting in such an instrument? Just to give you the investor perspective, okay? From the entrepreneur perspective, it's easy, because you've just sort of said, look, you don't know what the valuation is, we don't agree, so let me do A, B, C, D, and somebody will come and invest, and then we'll do it. Yes, that is the easy and the shortcut. But life is not easy and shortcuts, unfortunately. You have to take the hard road of entrepreneurship. Yeah? How low? It's as good as saying I'll take 100% discount, right?
Yeah. Anyone else? Yes.
Hi, good evening. My name is Puneet. I have a query. Other than investment, say you do some investment in the company. Other than investment, what kind of mentorship you provide to the company to scale up in the business?
This is a question for me.
For anyone and everyone on the panel.
So I can start with this question. So we as GHV Accelerator, when we decide to invest and bring on board the 12 months acceleration program for any startup, we have mentors panel, and instead of doing one-to-one, looking at the need in the acceleration program, which is a control environment we provide, whether it's the GTM, go-to-market strategies they need, or product development is required, or how to do the business remodeling, or how to do the smart hiring in the team. So depending on the need basis, the mentors work with them closely on a very structured manner where the quantitative and qualitative analysis is being done on a periodical basis. Just to take the name of some of the renowned mentors are like Rajan Anandan from Google, Rehan is there from Oreos, ex-Yahoo CEO Mr. Sharad Sharma is there. GoDaddy India MD, he's mentoring one of our portfolios which is in the app, is an app maker, and they want to make this venture, AppLog, as the GoDaddy in the app industry. So Rajiv Sodhi is mentoring them. So that's how we try to position the mentor. And other than those who are the mentors on the panel, we have industry experts who help them to give right advice, right connect to them in the industry.
All right.
It's a good question actually, because that is what we talk about, quality of money, right? So pre-investment, there's a lot of value add that we do for our for incoming or shortlisted companies. So we start working with the business and strategic structuring. We start our investors start working with the entrepreneur to say whether you should be simple things like B2B or B2C or what your market should be. In fact, one of the key inputs that one of our rockstar companies called Dhruva got was to say not to go to market in India but to go to the US. And now they are a global player. Second is post-investment, a lot of time is spent. There are a couple of leads who sort of lead the company, but they not only mentor and provide strategic guidance and sort of literally handhold a lot of things that as they build the company and bring the talent, knit the team together, all of that. But the companies actually leverage the network. So at all times, the investors, whether they've invested in the company or not, they really help the company in market access, customer contracts, and just the brand to say that it is an iron company or so-and-so is invested in the company suddenly opens doors for early stage companies. The second thing which has been very, very useful for our companies is access of key talent. So it's not only getting the right team members or getting the CVs or meeting the people, it is getting reference checks done. Meeting them, mentoring the team, giving them a vision, and that holds a lot of value for incoming key team members. The third is, of course, access to next round investors. I mean, a lot of the VCs are all sort of tracking us and our companies, and they are in connect. So that's a simple one to understand. But I think one of the most important inputs that what we feel that we've been able to give is suddenly raise the company's visibility. So, even without us doing something on our own, by getting them market access or doing a proactive reach out to talent or doing a proactive reach out to VCs, the whole media visibility when you put them on the platform, it automatically starts coming. And that's just, they are on autopilot to a great extent. And the last piece is as they take the next round investment, the investors or the lead investors actually hold the hand of the company under the table and literally walk them through the investment process and the negotiation. Because remember, these are largely first generation entrepreneurs. They're doing this for the first time. So this whole journey is an experience for the first time. So people who've been there and done it are who our investors are, and you can go to our website and you'll see who is sitting there from different sectors. It's that confidence and wisdom and that motivation and the backbone that they provide, which I think makes a lot of difference. And it could, to my mind, it has proven to be the real differentiator in companies which could have fallen off the cliff to doing better, and those who are doing well to do even better.
All right. I'll just put a pause for a moment. I want to thank two of our speakers. We are going to bid adieu to. They've got a flight to catch. I want to thank Padmaja Ruparel and Vikram Updhyaya for their time and their generosity.
Thank you very much.
TiECON Chandigarh has...
Yeah, I was going to say thank you very much. We'd like Puneet to present a small memento to Vikram.